Hello and welcome to our Made for YouTube series. I'm Sumaira Abidi, and today we are going to be talking about the growing popularity of passive products, why there is such a lot of attention that these products are getting from retail investors, what do they mean for your portfolio, what are the growing trends, as well as how to decode the vehicles which are available, index funds, ETFs, etc. Joining in to talk about all of that is Ashwin Patni, Head of Products and Alternatives at Axis AMC. Hi Ashwin, thanks very much for joining in. Good to see you again. So what is the allure of passive investing? Is it just that there is, something new, or is there really a lot of scope even for a country like India?
So it's actually not that new. We've had index funds, ETFs, pretty much as long as the mutual fund industry has been around in India. And of course, what has changed is the awareness and their usage. And you're absolutely right. I think we saw starting around 3 to 5 years back a dramatic change in the usage and the awareness of the broader market, and whether I say broader market, investors, distributors, etc., towards passive investing. And I wouldn't say it's gotten mainstreamed completely. Yes, of course, the numbers are there to see. We have more than 4 lakh crores in passives. But to a large extent, they are still driven by the more institutional allocations, Provident Fund, EPFO being the main driver. In fact, one of the big drivers, also the government with the disinvestment related ETFs. But I think slowly but surely the retail is joining the party. Direct investors are joining the party, and definitely the trend is there for everyone to see.
But Ashwin, what is the scope for growth over here? Because, for a developing country like India, active funds are still quite meaningful because there is scope for an active fund manager to outperform. Just last year is a case in point, right? So therefore, I don't see purely passive-driven portfolios in the near future. So what is the kind of growth that you as an AMC can expect for the industry to make here?
Yeah. So I feel it's a sign of a little bit maybe maturity of the asset management industry. I think if you look at the industry, we have moved from a stage maybe 10 years or 15 years ago where we had to make the case for equity investing. Start from there and talk about what is an SIP, why equity is an asset class worth considering. So we were, at a stage where we were talking about, few lakh investors in a country of more than 100 crores, to a stage where mutual funds have become more and more widely used. We still have not that much of a penetration as some of the developed markets, but I think we've come a very long way. And especially, I think, in the segment which has, let's say, reasonable financial savings, let's say in that segment, mutual funds today are fairly mainstream. And in that sense, to answer your question, yes, I don't think passive investing is about whether the market opportunities for alpha have dried out or whether, purely from that hat. But I think it's more about as market is maturing, there are different investors who are looking to create their baskets in different forms. It can be seen about, transparency, liquidity. Maybe a very simple use case, if I can just take you through in a minute, is, for example, active products you need to spend time and effort to understand what the fund manager is trying to do, and you have to pick the right fund. So it's not just about the potential for alpha. It's also about the effort that the investor has to take to understand what the manager is trying to do, what the strategy is about, how will it propose to generate its alpha over a period of time. The liquidity and transparency of the portfolio needs to be understood. Whereas when you come to passives, it is fairly straightforward. If you say that it is a fund that refers to the Nifty 50, very quickly as an investor, you know what you're getting into and what you can expect out of it. So I think it's not just about performance. It's a host of other things, including transparency, which come into the picture, ease of understanding, which come into the picture as well.
But Ashwin, even within this, we've seen ETFs There are index funds, of course. There are fund of funds. Now there are a lot of these smart beta products coming. How does a person decide, which product would suit them? I mean, is it to do with risk profile? Is it to do with, expectation of returns? Is it to do with the geography or, the product itself?
Yeah. So I think it's a very interesting numbers we ran on the whole category, and the number of ETFs available in the market have roughly doubled in the last 3 years, from just about 50 odd to close to 100. Interestingly, in this time, the investor allocation has actually become even more top heavy. So this is the paradox. It's a time when choice has exploded. As you rightly mentioned, you have a host of different sector, thematic, smart beta, host of other things. And yet, even more money now goes into Nifty and Sensex ETF than used to go 3 years ago in a percentage terms. So I think, yes, as an industry, we are starting to offer a lot of choice, etc. But as a use case in the investor's mind, I think it's still dominated by just the basic vanilla use case, which is how can I quickly get access to the market, which in their mind is defined by Nifty Sensex, and how can I just quickly sort of participate in that whole thing in a very easy to understand, easy to execute manner. This, of course, is something which I feel is a step in the journey. Over time, awareness will improve, understanding will improve, and we will see that breadth coming in terms of allocations as well. But today, I think it's clearly dominated by, I think the number that I remember is more than 80-85% of the allocations go into just these, Sensex Nifty kind of products.
Ashwin, besides just the Sensex Nifty, the other big popular category is overseas investing, right? Now, over here, we understand for the regular funds, the limit, to which mutual funds can invest abroad has been breached. So therefore, those are on hold. But, I was going through the list, and a lot of ETFs, fund of funds have also stopped fresh inflows, even though for ETFs, I understand that the limit is not yet breached. They can continue investing abroad. And that's a sizable chunk of this whole basket, right? So, what is the industry expecting on that front? And, should people continue with their investments? Is there anything for them to worry about?
So, I think these things, when you talk about investing outside India, there are limits which have to be factored in. As you rightly said, these limits are monitored from time to time, and the regulators obviously take appropriate action depending on where we are on the limit situation. As currently, of course, given the situation as an industry, we've had to stop flows. This doesn't change anything for investors who are already in these funds, because those funds have been deployed as per their mandate. And I'm speaking more broadly as an industry level. So far, the money that we, as an industry that we got, we had the ability to deploy, and which was continuing. And only incremental money which could have come in, which could have become an issue in case the ability to deploy was not there because of lack of limits. And to counter that scenario is when fresh inflows have been restricted. And to that extent, therefore, there is nothing really to worry about. If investors have allocated to any of these funds, keeping the mandate in mind, really nothing has changed for them if they're already invested. What changes, of course, is if they were looking to invest more. There are now some challenges around that, which we believe should be temporary in nature. We're obviously watching this space to understand how this plays out, but we believe that hopefully over time, these should again also get normalized as additional limits are released.
Yeah, and this is testimony to the growing popularity, right, of overseas investing. So, while it's a temporary problem, I think it's a good problem because, at least that there are enough investors who are interested in this category and the kind of, benefits that this category provides. And probably this is something that will get recognized by the Reserve Bank as well. But Ashwin, coming back to creating a portfolio by including passives, we're not yet at the point where we can go fully passive, right? So how do you make that active passive mix kind of portfolio? Are there certain products which are better, as a passive fund? Are there certain categories of, maybe market cap or, themes, etc., which are better as actively managed? How does a person make this mix in their own portfolio?
Yeah, very interesting question. And I don't think there is one common answer, because that's the beauty of having a choice of so many different type of passive funds and active funds, that it creates a very good amount of flexibility for investors to approach it in different ways. Now, there are 2-3 different ways people can use this. One way is to stay within the diversified bucket. Investors who don't want to get into taking a views on sectors or themes, so then they just worry about being allocated to the broad diversified indexes, and they can choose between actively managed diversified portfolios and passive diversified baskets like Nifty Sensex, or they could look at it as a large cap, mid cap mix. For those investors, life is pretty simple, because you look at your broad allocation, suppose 100 rupees divided between active and passive. How much to give to whom? I don't think there is a fixed answer. Today, if you look at an industry level, passive funds are about 4 lakh crores. Equity, including hybrid, is maybe 4 or 5 times of that. But at an individual investor, I think it boils down to your comfort, understanding how much time you're able to devote. I mentioned earlier that active funds require also a lot of time. It's not that you can just allocate like that. So those things have to be kept into account. So that's for diversified investors. Then there are more aware investors who may have point of views on sectors, themes, etc. And here passives can work pretty well, because specific sectors and themes views that you have taken, you may just want to implement them quickly through a very easy and transparent portfolio. And passives give you that clarity of portfolio of what you're investing in, and whether that is aligned with the view that you've taken on the market or not. So that part of it really works very well for the more active investors, if I can use that word. People who understand the market better, have the intention or inclination to really take a more active approach towards their portfolio, rather than just sitting back and giving the money to an active investor, diversified investor, and just letting them take those calls on their behalf.
Okay. Ashwin, just one more question. I wanted to know, what are the trends of the future here? Because, on the active side, the market regulator, SEBI, has been, pretty strict about categorizing the kind of funds which can be launched. But on this side, the scope for innovation remains. So, we've already seen a variety of smart beta products coming up. What else can we expect?
I think we will see a lot of choices being given. I think the one statistic which is very sort of often thrown up about the US market is that there are more ETFs there than there are listed stocks. And it sounds a little not right if you think about it, but actually if you think about it, it's not that, because what you're effectively doing is slicing and dicing different ways for different people who may have different objectives. I mean, if you look at, if I just take one sector, for example, which is a large sector, like let's say financials in India, you could slice it into banking versus non-banking, within banking, on private banking versus PSU banks, within financials. Of course, banks and non-banks financials are one, but you also have other parts of financials, insurance, asset managers, others, etc. So the beauty of passives is that it allows you to slice and dice and create a lot of these specialized baskets to approach different investors. My sense is that this innovation will continue, but I go back to my earlier data point. At an investor, I don't think people really are able to utilize that innovation today. I think in terms of understanding usage in their portfolio, in that sense, it's very similar to where passives as a category was maybe 5 years or 10 years ago, that the products were there, but people were not really using them in a meaningful way. And then obviously that changed with Sensex Nifty at least. I think we will see that change happening over the next 5 years, where people will figure out how to start using them, and that will give a further fillip to launching more innovative ideas from the industry side as well. I'll also talk about a very quick trend that some of the AMCs, including us, are doing is we are launching fund of funds that allow people to participate in this space where you can allocate across different ETFs. So that allows for relatively less mature investors or less sort of aware investors, if they just want to still participate in this space, there are easier vehicles which allow you to also do that. So that's the other way people could play that.
Got it. Ashwin, thanks very much for your time today and for answering and rather explaining many of the nuances that are associated with investing in passive products. So thanks very much for that. And for everybody who's been watching, I hope you found this useful. I hope it's been a learning experience, and we look forward to hearing from you. So do send in your comments, queries, and also suggestions for future topics you'd like for us to speak on. Thanks very much for watching. Stay safe.